look guys, got all-time high in everything but OPEC, and OPEC is cutting as much as they possibly can, and you still think there's a lack of investment in oil supply. It's not true. Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive Onyx Capital Group. I'm joined today for a market podcast with Martha Dowding. And just a quick reminder to please like and follow on YouTube if you're watching it there and anywhere you get your podcast. But we do push you to watch it on YouTube because we have the visuals and we're really good looking people, all the rest of it. So thanks, Martha, for joining. We have to stay with the narrative of OPEC. It's been all over the media for 2 weeks. They've been following the OPEC delay in meetings and everything like that, like to a T. So now that that's kind of ended, we're having the fallout of the OPEC announcement last week. Why don't you just summarize what's going on? And maybe we could start with the Onyx forecast we put on LinkedIn that we put out yesterday.
Yeah, of course. So my colleague Vincent yesterday released our view for the week, which is like fairly bearish, to be honest, looking at prices consolidating around 75 before maybe seeing a little support. And we've kind of seen that come to, a little bit of fruition, but obviously too early to tell. Lingering uncertainty about the economy and doubts surrounding the efficiency of the OPEC cuts, and then looking at the CFTC report, looking at money managers de-risking essentially in Brent with closing long and short positions. And then in WTI, we're seeing short positioning from money managers. So it's just bearish all round in our opinion there. And then looking at the rumors about the Saudi OSP cut, first time in 7 months, if that, it happens, that would be another, pretty significantly bearish factor.
Yeah, no, that summarizes it really well. I think the general theme is, actually heard someone say earlier on last week that money managers or financial players don't like OPEC, or I think what they mean is they aren't as responsive or sensitive to OPEC's moves. And I think that's very logical because I would argue the financial speculator in particular shouldn't get emotional about what's going on in the market and being right or wrong because they live and die by their P&L. So in other words, if they think the physical market is moving one way or the other, they don't have the physical to actually benefit from it in the physical contracts. They've just got to live and die by the derivative pricing. And when the derivatives fail to respond dramatically to OPEC cuts, and it's the same thing again and again and again, like multiple times throughout the year, I don't think it's that surprising at all that from a risk reward perspective, you're not gambling on, or at least you're not afraid to be short into these kind of OPEC decisions when they haven't had material impacts that are sustained in the market. So I think that's interesting. So we think essentially the downward momentum we've seen post-announcement this week is essentially confidence from the kind of macro money side, the financial money side. Yeah,
I mean, we're looking at OI increasing. We're not looking at, people taking profit. This is people putting on short positions, which is pushing the prices down. We're at open interest above, I think it's like 520 yesterday, or the most recent available figure. And this was after we saw some probably profit taking flow of about 6 million barrels on November the 24th, so ahead of the OPEC meeting.
It makes complete sense though, don't you think? Ultimately, both supply and demand and just outlook forecast, they've tried everything. We're up to 5 million barrels per day cut, whilst we're at all-time high US. Obviously Venezuela's back. Non-OPEC supply like Brazil that people haven't been focusing on is coming back or at least growing quite considerably. And we know that most countries are itching to maximize their production. They don't know how long the market or the world is going to need oil and looking to maximize what they can now, essentially. So generally what I was saying in the report that we released yesterday to clients is that it is that consistent theme of every time OPEC have cut this year, it's right at the cliff edge and then it comes back for a time and then it's just more and more of the same. They've gone deeper and deeper. I know everyone knows this, but you've got to see it from a positioning perspective. Like it's just a great risk reward to be short into next year now because the only bullet left is to cut like astronomical cuts, right? Really deep cuts. But if the underlying market isn't even performing, let alone the derivatives market, there's just not much downside. So I think if anything, if you were having to start to bet on your new year, in other words, to get your bonus at the end of the year to, make as much money as you can ultimately, it's definitely pointing more bearish than it is bullish. So I think, that's just unbelievably clear. However, like no matter what happens, there's always a push for a bullish market. There's always a push for higher prices. I think it makes sense because everyone benefits from oil prices apart from the end user, and the end user is the only one who doesn't trade, apart from, I guess, you could argue like the speculators, like maybe the people on Robinhood or whatever, these apps, the only way you can actually have kind of any kind of price authority over the market. So yeah, and it's almost like you have this like oil Illuminati. I'm saying yeah. There's always like it's not a conspiracy, it's just everyone wants to be long all the time, and the narratives are so inventive. Like I've been a bit on the road lately, a few different meetings, conferences, talks, speaking with journalists and reading what people are saying to journalists, and it's just relentless. It's like no matter how bearish things seem, it's like, yeah, but and the interesting one was shale. We've been talking about shale a lot. It's never not produced, it's never not increased since the COVID times. So it's weird that it's such a shock and people are only starting to realize it now. It's very odd, but it's just the consensus forming, which is ironic because a lot of this bullish narrative and bullish things and expertise is coming from market intelligence, from research analysts at third parties, at banks, at well, yeah, I get us as well, but ultimately I'm saying from the supply and demand forecasting type aspect. And it's ironic because it's meant to be really like expert analysis on objective data, but it's the opposite. It's forward forecasting on like very hypothetical demand increases and probably even hypothetical supply increases, because they got shale so wrong this year again. They got probably China so wrong, China production increasing even. No one seems to really talk about that. But it just all points to the reverse of what you're meant to do, which is they come up with a narrative and then they say how to make the data fit that and how to tell that story, but then relied upon as experts. And I always think it's nuts, but even the traders love it, right?
Yeah.
So
I think at the beginning of the year, like for the first half of the year anyway, that we had the like golden bullet of China. And now I feel like people are kind of scrambling for the second golden bullet, and they're like, okay, time is ticking. Like, what can we possibly say? Like, we want prices to, be above 80, because, we want to hit the 100 that everyone wanted at the beginning of the year. And
China's the interesting point. It is always such a big demand center. And I think it's such a shock that the Chinese economy is doing so badly, or at least not outperforming. And actually the majority of demand, the increases in demand expected next year, most of that is coming from China, from people's models. So you have to think, at the end of the day, everyone knows data from China is very hard to get precise and to rely on anyway. So if that's the majority of your demand increase forecast, it's not very convincing in my mind. But having said that, I think the complete flip side to this is there's the same thing kind of going on in the macroeconomic world, right? Everyone wants to be bullish equities. It's only really a long only kind of market, and then you get occasional short sellers opportunistically. But I think that generally speaking, we expect stocks to continue to run, and everyone wants the next bullish story. And once you get a bull rally in equities, it does evidently transpire into oil, and quite in droves. And it's been a big driver, I reckon, for the last 3 months in oil. They've been the only ones with real conviction, bullish and bearish, I think, money managers. So, having said all this, if they get excited off the back of a general bull run next year as the soft landing takes place, and interest rates, whether they go down or at least it's just a general end to kind of the misery, and we didn't get the recession and everything's looking healthy, low debt, high cash, genuinely a lot of people could be buying oil off the back of it. I think that's the better hope. So in other words, I would be going more on like US economy type growth rather than China, because you look at the China situation, everyone knows, right? The deteriorating property situation, it just hasn't looked good for a while. So relying on China and they have their own production, and that's increasing. And and we've had quota issues, and if anything, they're exporting more products, and it's actually weighing on the market. So I think that would be the big hope for me. And I say it from a position of encouraging the speculators rather than encouraging the physical players. Do you see what I mean? And that's all we can really say about it. But it's heresy to say that oil's going to go lower than like 60, I think, or it's seen as ridiculous. But I always, it's just, I know you've only been around for a short while in oil, but $50 per barrel, $60 per barrel was like, quite a good price for a long time in the last 10 years. It's actually, Russian budgets were around there, and they were open about that. And if anything, that was like the target price for quite a long time. It's just as that new normal being like, we have to be above 80. Like that's a completely arbitrary thing. Markets have been comfortable at $60 per barrel for a long time. So I can personally see it, but that's for the traders to decide next year as they kind of gear up from a speculative point of view. But just moving on, what can we say about like the refinery margins? What's happening whilst all this OPEC stuff's going on? What's been happening in refinery margins?
Same stuff, different week, to be honest, in the past few weeks. So, I mean, we've had a bit of an interest in like naphtha and stuff. So this is, if we get the screen up, this is the week-on-week change in the refinery margin. So green dated means that we've seen crude decrease week-on-week. This is Monday to Monday. Gasoil, same as ever, absolutely dragging the margin down, making it really hard for it to be a positive margin, even with crude so weak. And
I find when I first started seeing this, I found this quite hard to visualize, but once you get used to it, it's actually really good. So I
think having it explained, being like green crude means weak crude.
Right. So if you go to the right and you said the total, first start with the total. So the total increase is 67 cents, which you can see in the top right, but also the bottom right of the bar chart. And how that increase, what that increase was made up of is basically whatever's green. Yeah. So it's the fact that crude was weak allowed their margin to increase is essentially what's saying, but it wasn't helped by gasoil that's had another sell-off week on week.
Yeah, it's just been weeks and weeks of really weak performance. I think there's very little to say that we haven't already said there.
Where is the crack right now?
About 25. January is about $25 a barrel this morning.
So this is it. I mean, again, I just love talking about the psychology and the levels in markets, because that is it, right? Forward markets are just a fantasy. They're just a collective sentiment, collective positioning result. And I think the big thing in since 2022 was everything was kind of rebalancing, right? We had, obviously flat price going lower, spreads going, time spreads and Brent going back to normality, those kind of stuff. But gasoil has been a bit stubborn. It was about $40 per barrel. And then we had this huge crash at the beginning of the year. Yeah. But it's gone all the way back up again. And now if you look at it, you can see that the last 6 months or so, last year, had been, if you look at all the refinery margins, all the crack levels, they were all effectively reflecting the fact that we were in a big OPEC cut. So even with crude, negative Brent Dubai, or very low Brent Dubai, eventually going negative because Dubai a lot tighter market due to OPEC. And then of course the fuel oil markets and gasoil markets relative to naphtha and gasoline had to perform because of the same thing. And we've been rebalancing lately. And sorry, just to finish that off, it's just the fact that gasoil, I know we're saying it keeps coming low, but it's still $25 per barrel. Now, if I look at the spectrum of refining margins right now, and even Brent Dubai forward curve, I look at that and I think, yeah, that's actually quite reasonable. Yeah, DFL, small negative, 2024 Brent Dubai, small positive. All the cracks seem to be where I would expect them in the historical norms for the last 10 years. And gasoil would actually say, oh, that's a bit on the high side, $25. So I think it could still, just from a purely psychological perspective, I think traders could accept an $18 per barrel crack, something like that, to 15 and 18. And we've still got a bit of give you can get to kind of balance it out on naphtha, but it's in the single digits now again, after being like double digit low for so long. So I think the refining margins can still rebalance a fair bit, but in general, I'm saying it's finally, it seems like we're in a market that is historical norms. That's kind of what I'm saying. So I guess what's the one to watch? Maybe not off that, but in general, from what we've been saying.
I think in terms of one to watch, I think the most interesting kind of price action the past week has been in the light ends, and I'll probably do talk about naphtha and the trade idea. But in terms of what was happening last week in gasoline, I'll just get the chart up. On the screen, this is the graph for the RON 92 Jan-Feb spread. And you can see that coming into December, there was absolutely huge sell-off. And so basically I was looking at this last week, and so all of the like physical and fundamental...
Absolutely huge. You know, if I said that at my last place, I'll get screamed
Okay, not
at.
absolutely. It was a
20-cent sell-off.
It was a fairly significant sell-off. A striking sell-off, one may say, looking at the graph.
Breaking the trend upwards, yeah. Okay. Yeah.
Just trying to keep it dramatic, keep the listeners interested. So in the East, we'd seen the 92 being propped up by loads of MOC flow. And it was the MOC for like probably the whole week have been really ubiquitously bid, and the windows, and it was the paper contracts have been really heavily sold, selling flow from 2 Euro trade houses consistently, good volume, and the spreads only really being bought by market makers. So cash premiums weakened, and basically it came to the end of the month, and it was like the market was ready for a regime shift. MOC flipped to offered, and we've continued to see MOC be offered yesterday and today. Yesterday, I think, was just Jan. Today has been Jan and Feb around minus 20.25 cent. So that was an interesting. That was a one to watch, and we think it's probably going to rebound a little now on strength with basis of low Chinese exports and refinery issues in Taiwan, which means like probably some short term strength there. And also like just market correction from the...
Not so long ago, we were bullish these gasoline spreads. So I think that if I remember correctly, the thinking was, it had in it like another step change up, and it looks like that was happening, and then suddenly we've corrected. So I would say just on the fact of the players you mentioned being trade houses, the fact that it was market on close, I think the likelihood is that was them being long and taking profit.
Yeah.
Because if you have to get rid of a lot of volume at once, that is what market on close is good for. And it's the same with TAS and Crude. You have a lot of volume that trades there, and obviously that was taken advantage of by the Essex boys in 2020. It's a lot of people are trading that just simply administratively, right? You have a hedge that's rolling off, and you want to just get like a fair price for it, and you're not too bothered. And I think as that's evolved and got more liquidity, it's good as a speculative exit point as well, or even entry. So I would argue that looks like, especially it's been trending up, and suddenly a correction. Yeah. They're thinking this is gone as far as we think it can go now, and we're going to take profit. It's as simple as that.
Yeah, I think with the cash premiums being weak at the end of last month, and players are probably expecting like a weak physical pricing this month. So I think profit taking would really make sense there too.
Which is a bit of a shock, because I'm going off what we were saying a while ago. I think we were thinking it could really perform in Asia.
Yeah.
And so as you say, we got the signals that that's not the case. So cash premiums in early deck have clearly come in low. Is that what you're saying, or a lot lower?
Yes, the cash premiums were weakening at the end of the month, end of last month. But I think we're going to continue to see a bit of support, like with the short-term basis with the refinery issues. And I think with the Chinese exports being, low, see a bit of support in the longer term too. But
no, but this is really good because again, it's about what can you really do as a paper player or any player trading derivatives. You've got to look at the signals. So the cash premiums are a great signal. These are indications of prices relative to the benchmark in the future ultimately. So it's a great indication that forward physical demand or supply, is not in balance. And then when you see MOC trading in higher volumes, this is a signal. As I'm saying, I can derive a narrative that is it's probably profit taking, given we knew from our data that the market was long. We know these players tend to hold these positions, kind of disproportionately to, say, hedge funds, etc. Trade houses more, in line with the physical, speculating that way. And it makes complete sense that, that the two marry. So then it's like, well, do you get short here? But the problem with profit taking is that you go into a state of the market not being irrational, but ultimately needing to, a bit like we've seen with Brent, like it's de-risking.
Yeah. So
to get short is not really the point, because a profit taker is only going to take profit whilst they're in profit. So chasing the market down makes no sense, because unless you think something dramatic has changed and we need to bail and we're so worried, but you don't tend to see that price action when people are in the money. You see that when people are out the money. When they're stopping out, they're going to chase down, hit any number, because at the end of the day, they have to get out.
Yeah.
Whereas a profit taking in the money, you sell as much as you can at a level you're happy with. And then if it's going to run away with you actually kind of go, okay, I'm just going to wait for it to come back. So I kind of get your point. It's been sold into a huge amount of shock volume all of a sudden, and only market makers there to take it. It's probably likely it will kind of bounce back.
Yeah, I think so anyway.
Dead cat bounce. And then we will get a return as we approach these levels. So you can kind of look at this. I mean, that level on the spread was around 60 cents. So 55 to 60 cents, you could probably expect a continuation of that selling. Would be my argument. So that's a really interesting one. And again, it might seem like these things are very niche, and there's listeners who can think, yeah, I know about that, I trade that, or I'm aware of these markets, these like niche futures markets. But why is it important? Because it's genuinely giving you real information about the physical. So just material macro sentiment and macro views it's okay, but it's only really influencing people who can trade huge positions that only tend to do it like once or twice a year, and that's the trade houses and majors, and everything else is just macro fast money, just trading on macro sentiment. So, it's not really indicative of anything that's going on in the physical. If you want to hear about what's really going on in the physical, that's what's so good about these futures contracts and these signals we're talking about, like cash premiums. So, that's essentially saying, look, this reduction in margins, this bearish environment we found ourselves in flat price or in oil in general, is materially coming from physical as well. We've got contango in the front Brent spread, which is 2 months forward Brent, physical loading Brent, and that in contango is very clear signal the market doesn't need the oil. And you've got WTI, which is in contango further down the curve, so not just the front spread, more than the front spread. So that's a sustained period of physical weakness in the future. And then you've got gasoil getting hammered, and you've got gasoline with weaker premiums. It's all looking genuinely bearish, not just financial speculators punting. That's not what's going on. And okay, is there anything else you wanted to say maybe on let's have a trade idea then.
Okay, so this is a bit of it's breaking the trend of looking at kind of the financial, well, obviously looking at the financial flows, but in terms of technicals, this is already like at I'll be conservative with my language, pretty high level. If we get the graph up now, that's a pretty high level.
Yeah, it is, yeah.
So we're expecting this to continue to see strength.
It is a good point. Like, it's been in the doldrums for all year, right? The naphtha crack. We were getting used to, we got to like an minus $18 per barrel. And that's usually the levels you see in a weak residual fuel oil market, let alone naphtha. Naphtha lows tend to be 10 to 12 historically. So minus 8 is getting back, or minus 9 is getting back into like the normal ranges. So I think that's, it's a very significant retracement we've had since.
But it's still not to like historically high levels.
No, it's been positive for quite a while,
So we're looking at just like fundamental reasons essentially, but also we're seeing coming into December, we saw players holding their MOPJ, which is Asian naphtha, into pricing, which is going to continue to bolster the spread and also therefore the Q1. But obviously we're looking at European naphtha here, so we have to why are we choosing this rather than MOPJ, which is the Asian one? And that's because the East-West, which is the difference between the two, has been really offered due to the physical hedging. And once the negotiations for the Black Sea cargoes are concluded, in the coming weeks, we should continue to see this really large sell-side interest in the East-West, which kind of we're seeing players kind of selling the rumor on it already, and we're seeing players kind of easing into their positions, but we don't see any reason for this to end. We can think that, especially in the Q1, they're going to continue to be offering the East-West, and also we're seeing less Russian origin barrels than expected, and refinery maintenance in the Arabian Gulf in January. So I think as a whole, the naphtha market looks long, and for the reasons aforementioned with the East-West, I think that the best place to put your risk would be in the Q1 naphtha crack in Europe.
Interesting. There's quite a few things going on there. So generally speaking, you think that it's trending up, so it's not fighting the trend, it's joining the trend. You still think that's got more in there. I think you're suggesting that there could be some safety being long into pricing because the physical is actually performing. So that all makes good sense. But then you're actually saying that's the kind of collective naphtha market, but localized. The East-West has had some physical hedging selling flow. So, sell East, the selling of East versus West means actually if the overall market's long, then by selling the East-West, you're giving more ammunition for West to go up. So Europe could go higher or have additional buying flows coming from it, from the East-West selling. That's very interesting. Just from a positioning perspective, can you get up the naphtha crack positioning?
Yeah, so we've got that here. So this is the 7-day market trading split. So it's seeing day-on-day increases in length, well, like week on week, discounting a bit of profit taking, but seen by the OI decreasing. But I think that there's definitely room for more long positions to be entering the market here, especially with the OI decreasing a little in the past couple of days. Well,
this adds to your argument for sure. So if we're going up, trending higher, I mean, again, this is just classic. We're at the higher end of the range, so you tend to get sellers coming in, just like biased to like where it's been essentially in the rest of the year. So staying objective, if you think the physical premiums, physical signals look strong, the flow's going that way, or at least the trend's going that way, then actually, if anything, you could get stop outs because we're still trending higher. don't fight the trend. It will get to a certain point where all these shorts need to cover, and actually you could get a bit of an explosion of volatility as people stop out towards the upside.
Yeah, I think also when it's being implied higher with the east-west selling, you're going to see people using the naphtha crack to take profit in that as well.
Interesting. So this is the other thing about naphtha is that, and the gas versus naphtha, so gasoline versus naphtha, the gas nap, those contracts, they're so susceptible to other flows. So people look at it in isolation, understandably, obviously, especially the spreads and the kind of structure. But when you look at the crack, there is as you say, it can be influenced by east-west flows. It can be influenced by gas versus nap flows, which is, blending economics. It can be influenced effectively just by the gasoline market in general, be dragged higher. So people buying naphtha because gasoline's going higher. So when the market's trending up, but then the market's short, that's pretty indicative that something's going on that is driving naphtha flow higher, driving naphtha market higher through buying flow that you're not seeing localized in the naphtha crack. So that's most likely coming from gas nap selling. That would be my guess. But if we could have a look at gas nap, that's heavily short. And I guess the gas nap have been getting to very historically high levels once again. It's kind of been the recurring theme the last few years, but that's very short. Could you just go back to we've got a very high open interest as well, which means, way above the 5-year average. So that's a heavily invested contract on the short side. So that's evidently driving naphtha higher. So as long as there continues to be shorts piling into gas nap, it's probably likely that there's more buying from naphtha coming from selling of gas nap than there is selling of naphtha crack. Do you see what I mean?
Yeah.
And it's overwhelming it. So, and look, from all the data we're seeing, the market's adding risk to this gas nap. So that's very likely what's going on. And then if you combine that with gasoline, any buying flows that come in, but it's been a bit softer, isn't it, gasoline? So that's probably not likely that, but it's a risk to help you kind of drag naphtha higher is what I'm saying. So that's a super interesting one, actually. Really glad you brought that one up. That could be a very interesting crack going in. And I guess, just superficially looking at it, you're going to go, that crack's too high, just because you're biased to the rest of the year.
Yeah, in reality, it'll be interesting to see how much further up we can go.
Yeah, great. Okay, that's a really good one. Right, so kind of got into a bit of a routine doing this now, but the LinkedIn poll we've had running, the latest one, should we get that up? So this was, what will the outcome of the upcoming OPEC meeting be? A few number of people expected end of the cuts, flow coming back online. Same number of people expected cuts beyond 500,000, and most people expected just an extension of December. So actually kind of deepened cut is what happened. Technically, the unlikely scenario of deepening cuts beyond 500,000 was achieved with everyone but Saudi Arabia, and Saudi Arabia were extending their cuts. But I think as we say it, it's almost like but are we sure that's true? I mean, I don't know how much evidence there is that is actually what was said. It's like we know that it was said that other countries will take on more of the burden, and we were given the numbers. But we don't actually know from what level, right? Is that I'm right in saying that?
Yeah, I think part of the reason that, there wasn't the kind of bullish, impetus as people were expecting, people who maybe, were less versed in what was going to happen, that there was so much uncertainty on the day. Like, people I know on Twitter were like, the meeting started, like they were kicking off, and they literally hadn't even gone into the room yet, or the online room. So I think there's so much confusion, and
that really annoyed me. I was like, so what? This whole thing has just been talk.
So funny.
It was whose tweet was it that?
I think it was wasn't it Amina Baker?
Yeah,
she was like,
said, by the way,
they've not got it.
Not even started the meeting, right? Okay.
But I think that sums it up really. Like, no, there's just so much uncertainty, and I think it would be kind of in their interest to be a bit less vague, but also they just do like being as vague as possible.
Yeah, I think when you've again, we put this in a report yesterday, ultimately when you're at a poker table and you've kind of exacerbated your options, and you just have to bluff really, and you haven't got anything to bluff with other than like cryptic language. So you could just imagine, and I always use poker analogies, I'm not even that big of a fan of poker, but someone like just talking a lot of shit on the floor, on the table, being like, I've got an amazing, you're just talking. Yeah. And it does influence people, but you've not actually done anything that material, it seems.
Talk is cheap.
The talk is cheap. And ultimately, if it was a big cut, I mean, why not shout about it and be really clear? We've just done a huge cut here. I don't know, it's just getting a bit, it's quite obvious that they're clutching at straws again and again. But Yeah, I have to say, I keep saying this, but you know, we have to be at the end or nearing the end of these unsustainable cuts, and if the market doesn't perform during this time, which it clearly isn't, then it just has to reset, and we have to get used to it. The only thing is, again, I've said this before as well, but the time to, you know, when you're cutting production or when you're doing QE, like these kind of things, you know, you have to accept a time, the best time, like, a bit like when we came out of, I know this is random, but a bit like when we came out of COVID lockdown, the third time or the last time, it was like, well, technically, like, you know, we shouldn't, I mean, this kind of data is not amazing, but if we don't come out now, like there would always be a reason to not do it.
Yeah.
And I can kind of see that with this. It's like, when is the right time to bring oil back online? Because they didn't bring it back online when oil had reached 130 odd, 120 to 130 odd per barrel, and we were in the tightest physical market ever. They actually cut from that point. So if you weren't going to bring oil back online then, like, there is no time that it's right to do it. That was the time to say, okay, let's create some balance here. Instead, they just completely shocked the system. Massive demand destruction from the physical side, from all the cost of living crisis, but also from the financial side. You know, it broke down because everyone was overlong, and then liquidity issues, volatility issues, all well documented now. It actually drove the price lower. But now you've got a lower price with deeper cuts. And what can you do? If it's QE, you have to keep printing money. If it's OPEC, you have to keep cutting production. And if it's like COVID, you'd have to keep like locking down, because it's like, what are you waiting for?
Yeah.
So there is just an element of, I doubt they want to accept that they were wrong, quotation marks wrong, or that they've mistimed this or have misjudged it. But, you know, it would be destructive to come out and admit that and bring back production. I mean, you're bringing back 5 million barrels a day. Imagine if you just said that, right, we'll bring everything back to normal. We're going to add 5 million barrels per day on the market. That's the equivalent. That's worse than the pricing war in 2020. So they've actually just completely kind of screwed themselves now. They couldn't rush that back online. But if they want to slowly get it back online in the next couple of years, we will have lower prices. But what is the alternative? I guess just getting used to a low baseline is accepting, no, we desperately need this higher price. But if the price keeps getting lower whilst you have a deep cut, like, it's just kind of rebasing where that low can get to. So where it could have rebased to like $40 per barrel if you bring back the oil, if you brought back the oil this year, now it can rebase to like 20 if you bring back. You see what I mean? We've had these kind of like doomsday predictions in equity markets, and like everyone was predicting a recession at the end of quantitative easing and monetary tightening, and it was like the market cannot take it. No one's ready. The debt, it's going to crash. We're going to have the worst recession ever. And then ironically, everyone was kind of preparing for it, and it didn't happen, or at least didn't happen this year. So what does the market do, kind of knowing that this oil is ready to flow back online whilst non-OPEC is still growing? It either kind of starts to realize this and has this like doomsday predictions, and we get serious crash in prices, or I don't know. I just can't think of the alternative. It's like blissful ignorance from the opposite is that the traders and the media and the collective or Illuminati are saying that no, prices should stay high. The demand is strong. We are bullish, even in the face of all this stuff, all this cliff edge type stuff we're talking about. So if anything, it's the opposite of what I'm saying. Like, no one's actually calling for a doomsday scenario. So no one's prepared for it. So it could be a bigger crash. Do you see my logic?
Yeah, definitely. Whether it's going to swing one way or the other, when, you know, you're backed into a corner, that's when, you know, animals lash out.
Yeah, but then what I'm saying is like, by being prepared for this almost in the macroeconomic world, the world could almost prepare. It could kind of, you know, drastically kind of resolve the situation. Like, if you say to someone, we're not just going to have a tight oil market, we're going to have the tightest ever, and you're going to have like queues and queues coming out of petrol stations like we did last year. Sorry, the threat of it last year, like more with nat gas. Governments went and, you know, right, we're building terminals, with agreements with Qatar, agreements with the US, agreements with Australia.
Action stations, yeah.
And they've just actually exactly say, and they just sorted it out because it was like accepting. It was like, right, we've got to sort this out. But if you don't accept, like the first stage of, or the last stage of loss, acceptance, they're not accepting it. The market is not accepting that this is going to happen.
But it has to be something solid enough for them to accept it, because they're not, if it's just rumor, then it's just going to be rumor, and there won't be proper preparation. It won't be action stations then.
Well, that's what I'm saying.
Yeah.
But just looking at the numbers, 5 million barrels per day on the sidelines, and that's not even including spare capacity. Like this whole propped up argument for years on end being like, we don't have enough investment in oil, we're going to get a supply crunch. It's like, look guys, got all-time high in everything but OPEC, and OPEC is cutting as much as they possibly can, and you still think there's a lack of investment in supply, oil supply. It's not true. So I don't know. Yeah, I can see a big crash basically. But anything else no, good. Yeah, that was an interesting one. Thank you, Martha, for that. And yeah, people don't tend to interact too much with the YouTube comments, but please interact with our polls then, because they provide some interesting context for discussion. And please remember to like and subscribe, mainly to our YouTube channel, please, because it's going up in subscribers and there's more and more content coming, and we're putting a lot of effort into that. And generally, thank you for listeners out there, and see you next week.